I want to take us next to gold. Gold's actually been acting pretty strange lately. It moved all the
Mm,
way up to $2,000 and then failed
yeah,
to break that $2,000 threshold. So it looks like, I mean, if you look at this thing over the course of 2020 up until today, I mean, that's three tops. It's a triple top. I
yeah,
mean, yeah. So what do you think is what's going on with gold? Are you interested in gold? And what's up with the gold miners? I mean, these things have been unresponsive and left for dead for a while now.
yeah. My first observation with gold always is it's a political metal. It's I kind of it was as soon as I started researching the sector, was the first conclusion I came to was that this doesn't trade on sort of supply demand because there's the paper market just keeps expanding. No one can ever tell you how big the paper market is, and so as soon as I worked that out, I was like, oh, I don't really want to be part of that. If the paper market can just expand to make sure supply and demand sort of match up. And I've kind of avoided gold ever since. Granted, I think there's some good arguments now that the likes of China and Russia are positioning to um, take out the paper market and make, as it's within their interest, they could back a currency or currency basket, buy gold. Like Luke Roman's done a lot of good work on this, that they could have convertibility between gold and oil. Even at the moment, there is gold convertibility on the Shanghai Gold Exchange, I think, which is kind of some pointing to that being the start of this. And in that case, there is a really large like sort of call option within gold. Should the paper market be wiped out and it be revalued? Um, don't know where it would land. So that is kind of exciting. But for now, I'm just far more comfortable with energy.
Yeah.
I yeah, I've sort of said I like the OPEX over sort of the CapEx commodities and gold. Gold did even trying to work out the demand side of gold's really tough. Like the with with commodities as it kind of started with uranium, it's I like demand. I like to focus on supply and see the supply side absolutely beaten up. But then with the demand side, I'd like either uranium type demand where you can just figure out how many reactors there are, how many have been built, and that's kind of knowable demand, or you've got the likes of like coal or particularly thermal demand. Everyone just wants it to go away every few years, and so no one will even forecast a long-term demand trajectory. So every year is another surprise that sort of thermal demands hitting another record high, and so it just kind of surprises the upside year after the year. Whereas like all the I've listened to a lot of hours of sort of gold bug interviews, and every time I listen to one, my takeaway is like, well, if they're right, I think I still do better than them in energy, and so that's why I just haven't found it interesting enough to, or I don't think the setup's as attractive as the energy. I think energy continues to outperform gold by a large margin over the next decade, as it did previously in the sort of the 60s, 70s, 80s. I think um,
Right.
if you run the numbers on all of those timeframes, the oil price, the oil equities outperformed gold by roughly sort of I think it was 10% annualized, and I think probably do the same. And that was back then when oil was quite expensive and gold was quite cheap, and it's still outperformed by that. And now we've got the other way around. I think gold's more expensive and oil's quite cheap.
Yeah, I like the fact that you brought up the paper market. This is actually a really cool ratio to look at. So this is GLD divided by the actual gold futures price. And you can see here that GLD has actually been declining compared
Okay.
price in gold. So, I mean, to your point there, I mean, this has been a consistent thing until, since as far as we have this recorded, if you draw, we just try
Mm.
to map this out. I mean, this is down about 8% over the course of 15 years. So, below an 8% underperformance of the metal that is supposed to track.
Yeah.
and
Yeah.
it's
And there's
pretty
also like
consistent.
what inflation's done over that time as well. It's not supposed to be protecting purchasing power, and it hasn't done a
Yeah,
great job of
just
that either, really.
just
Mm.
but for the audience's sake, I mean, GLD versus gold in theory, should be a straight line, right? GLD should be
Yeah.
1-to-1 with gold, but what we see here is that GLD has actually been underperforming gold, or gold's actually been overperforming or outperforming GLD, meaning that the paper market hasn't been able to keep up with the actual gold price within a long stretch of time. That's what we see here. Cool. I also want to get your take on, something like copper. This is the copper to gold ratio. And I kind of like looking at this to kind of get a gauge in terms of like how strong the economy is, right? In terms of like strength, you'd expect copper to outperform gold. And then in terms of recession, it's vice versa, right? You had the GFC here, and then copper relative to gold dropped all the way down to these levels. And this is where we're at today. But what's really interesting, and this is something my friend Andy from Finding Value alerted me to. So if you actually map, so this is the TNX here in yellow, and if you actually map this thing against, against the what is it, the copper to gold ratio, you'll see a pretty good mapping, right? It tracks it fairly well, but recently, 10 years actually been outperforming the copper to gold ratio. So there's all kinds of weird things happening in the economy now where correlations are starting to diverge from one another there. So so in from what you've kind of been able to gather, um, the copper to gold ratio is telling us that it's kind of giving mixed signals in terms of a recession, whereas the TNX is giving us signals of a recession. Or no, sorry, vice versa. Copper to gold is saying recession, TNX is saying no recession. So what's kind of your take there? Uh, do you see any sort of weakening in the economy that could lead to a recession, global recession, anything like that?
Uh, I don't know if I'm smart enough to work it out. I like the way I go about it. I was like, work out how bad would a recession need to be for it to really impact my investments at the moment. Um, I just don't see anything other than like a real sort of like COVID type lockdown, um, breaking any of these, like have been able to offset the gap between supply and demand at the moment. I see. I think if we even get one, it's going to be fairly mild. It's kind of like my take at this
Mm.
point. Granted, yeah, I wouldn't put much weight behind that. I'm not much for economist. I even, my mentor, he always sort of, whenever I even start talking about this, he's like, "What's your edge in forecasting recessions or anything?" And I'm like, "Yeah, nothing.
Yeah.
It's just focus on where you've got a good margin of safety and um, where things are knowable. There's like got to be really careful. Like once you stray into macroeconomics, you can try and sound smart, and none of it tie back to making money. Like, yeah, it's always my mentor Brad. He's always just saying like, "That's interesting. Tell me how that helps me make money." And I'm like, yeah, okay.
Yeah, it's a good
That
point.
was just like what? Yeah. What waffling on like velocity of money or yeah, it's just if there's going to be higher chance of recession, how's that going to impact your portfolio? And ultimately, it comes back to really um, knowing what sort of margin of safety you've got with your positions, knowing the future sort of supply demand, and from there knowing that's enough to position you well. Like I always go through. I think it's one of the things that gets sort of over, like people just don't understand how resilient sort of oil demand is. Like you can go back and look at like the GFC, like that big bust up in oil demand was only down sort of, it was 2.5-3% year on year. Granted, prices bounced all over the place, but if you with fully locking down the world in COVID, that was 8%, 8.5% year on
Yeah,
year.
there it is.
And yeah, Yeah, so
That was it.
these, it's crazy once you start looking at it in these terms. So you start to realize how, like, a lot of the doomsday headlines that you read, and how robust sort of oil demand is. And once you kind of grasp that, it gives you a lot more conviction to sort of hold through these periods. Like, I think it's Farclav Smil, that's like there is no difference between sort of growth and oil consumption. They're essentially the same thing. It's tautology. You can map them both over the same chart over a long time, and they're almost identical. And to think that they're going to deviate at any point in the future, I think it's just ludicrous at the moment. EVs aren't going to put a dent in it. We don't even know how to replace any of the constituents that we make from a barrel of oil, like whether it's plastics, whether it's all the. He's got this great piece on the foundation, the four pillars of modern society, which are the likes of cement, steel, plastics, and ammonia. And we don't have any cost-effective ways to make any of them without fossil fuels. And once you kind of start viewing it through that lens, you're like, yeah, okay, everything else is just mate. There is stuff that gets thrown up, but it's always, no one ever questions the cost. Like, automatically some people will be saying, oh yeah, but you can produce ammonia via hydrogen, via renewables. But like, show me all the costs in that versus doing it just straight via cheap natural gas. Like, it's yeah, it's interesting when you work out just how little of a barrel of oil that we could actually replace with all the technology today. And so working that back to what was originally the question with recessions, is we're addicted to oil, and there isn't really a recessionary situation that would scare me out of my oil positions. I think the supply situation is so dire that offsets even a pretty harmful demand. So sort of even a global recession. Granted, it would be probably a tough year or two in the positions, because not everyone would agree with that take, and they'd sell off pretty heavily. But ultimately, it would still all come right, and that's where having a large margin of safety would get you through.
Yeah, I mean, a lot of people discount the fact that we pretty much live in a sea of oil, a sea of oil derivative products, right? Like this green screen behind me here, I mean, it's the fabric that it's made out of, it derivative of oil. The carpet, underneath this table is made out of oil. My phone, like materials in the phone and everything, you need to extract them with cobalt and everything, using machinery, that diesel powered like machinery and all this stuff. Derivative fossil fuels. So it's all around us. Like, we're just swimming in it, and people are just blissfully unaware and unappreciative of the fact, the lifestyle that things like hydrocarbons give them. I want to take these last set of questions. I want to talk to you about some of your methodologies or philosophies behind, like, setting up a portfolio. I know I don't know if this is still the case, but I know at one point, you were living off of dividend paying investments. And I kind of want you to walk the
options.
Okay. So I want you to kind of
option income.
Got it. Option income. So if you don't mind, like, kind of breaking down to the audience, like, how they could employ, these kind of techniques to allow for more, economic freedom on their end. If they want to escape, like, their 9-to-5 job. What are some ways some things that work really well with you, that you can kind of tell the audience?
Yeah, so I'm a big proponent of options trading for income. So that was how I had the confidence to quit my job coming up 8 years ago. So that was, I split. I always sort of recommend that if you're going to do like full-time options trading, to have a separate long-term account and a income account. So I had two interactive brokers account. One was purely a income orientated account, and from there, always the sort of cornerstone of a lot of my my income trading was covered calls. And so it's one of the most basic sort of option strategies, but there's a lot of like sort of angles you can find with it to produce pretty decent income, especially if you're on some more hated stocks that are quite volatile and you've got conviction around the stock. Some of them have great dividends as well, which adds to your ability to sort of live off smaller amounts of capital. And that was how I originally, yeah, got enough of a monthly income that I could then start traveling and trying to build it up. I did have some, did manage some money for some high net worths as well, but probably 2/3 of my income was like on a month-to-month basis was from options trading. And how I learned that was just mostly on YouTube and then just doing it. Like starting with covered calls is fantastic because you can have really small outlays, and if you know how to use some of the tools on the likes of IB, you can I'm thinking there's some that you could outlay below sort of $300. You could set it up for a month, maybe 40 days. You'd be able to make sort of 5% return for the month. You can set it up that you only enter the stock and the option position if your prices get hit, and there is no downside. Like when everyone hears options, they're always scared of like the stories of sort of people that have sold naked calls, and then it's kind of like selling insurance, and then it blows up in your face and you blow your account up and you're on the hook for more money. Like I never have any sort of non-defined risk. Like I always know exactly what risk I'm running. With covered calls, it's generally just the stock going down that you've bought, and if anything, it's actually safer than buying the stock outright because you've got the premium that you've received by selling a call against the stock. There's no taking that off you. That's a guaranteed payment, and that reduces your price and the stock. So hence why it's important to have a strong view on where the underlying company is, that it's got a good margin of safety, not gonna go bust on you or even have a heavy drawdown from that point. And yeah, that was, I kind of built that strategy. I added some more sort of tactics to it over the years, probably too in depth to try and explain it all here, but that was my sort of bread and butter. And so I always recommend everyone kind of at least understand how covered calls work. It's also great for, I still do it in my long-term portfolio now. If I want to balance from one position to another, start selling covered calls on them, so that if I get exercised out, I can move that capital across and I've got an extra return. Sometimes when I feel a position's just got really extended, then I use covered calls in that scenario as well, just to kind of boost the income, and like I play on mean reversion. But yeah, I think it's one of the more powerful little tools to have in having your arsenal for just making money over time.
Awesome. I want to ask you about the capital gains portfolio that you have now. When you identify these asymmetric positions, do you leverage any charting at all, or do you just stick to fundamental analysis, or do you wait for breakouts in the charts to confirm your positions in these things? There's people out there that say you can buy an investment at a beaten down price. And we just looked at coal not too long ago. It's down 80%, but there's no telling that it could go down even further, right? So how do you kind of know when enough is enough? Has it been beaten up sufficiently? Do you look for breakouts, etc.?
Yes, most of technical analysis I do use as sort of a starting point. Like, why is this so down and out? Why is this so hated? So probably technicals would probably be 5% of my process. It's just sort of asking why the chart looks like that, why is it so down and out, and then start the fundamental side of it, which is just digging into the company, digging into what supply demand looks like, how much risk is there with the company, like cash, debt, what are their maturities on their debt, what are the sort of the history of management, like if you're going into some places like Indonesia or something, you got to be pretty damn careful that it don't get it stolen off you. There's been a number of coal companies that have been sort of privatized, or shareholders have had a pretty bad outcome. And then just really looking for the absolute hated stuff. Like my favorite was always the ones that go bankrupt and then pop out of bankruptcy. Like anyone that could look on YouTube at all my old stuff, of some of my biggest positions have been Paladin, which was went for a bankruptcy, was Peabody that went for a bankruptcy, Diamond coming out of Diamond Offshore came out of bankruptcy and really loaded up on that when it relisted, or spinouts as well, like the some when companies are dumping something for sort of a non-economic reason, like a Anglo-American when they got rid of Fungella, like BHP when they're getting rid of Dornier and Blackwater. They just want coal off their books. It's not because they're not profitable assets. They just want to get rid of them. And so between sort of the restructurings, Chapter 11s, relistings, and like spinouts, that's kind of been where I've hung out the most the last few years, and that's where I've probably had the most conviction to jump on positions. And you're also getting, you got to be so careful in the mining space that you're not just getting screwed with all the dodgy business that goes on. So whereas with a restructuring, often you're getting in with what were previously the senior debt holders, so they're having a debt for equity swap, they're getting equitized, and they're almost starting at the same level as you when you're buying in when it's been relisted, which I kind of always liked. You can even sometimes get like warrants and other stuff, but getting in with, like, I suppose, a smarter money or whatever you want to call them, as opposed to sort of some mining setups where they've got, by the time it gets to the market or gets IPO, their cost is in the cents when it's listing at $1 or something, and so they can dump and make a lot of money regardless of how the company actually does. Whereas you don't generally have that with a lot of the sort of the relistings or spinouts. So that's where I've kind of found the most asymmetry, or the biggest edge, I guess.
Excellent. Well, hey, Trader Ferg, thank you so much for coming on the show. Really enjoyed, my time. Got some really interesting insights to look at here. Highly recommend people go and follow you on Twitter. Can you also tell the audience what your website is and other places that they can follow you as well?
Yeah, so it's just the main spot where all my stuff is now is Trader Ferg at Substack. Yeah, it's I've got a weekly Ferg's Finds that comes out, which is just a free email with my favorite article, podcast, quote, chart, and something that I'm pondering. And if you're interested, just put your email in, and I'll send you that every week. And everything else is kind of just really long format videos and deep dives into mostly energy at the moment. Yeah.
Great. So we'll have all that linked down below in the description box below. If you enjoyed this content, be sure to like, subscribe, comment, do all this YouTube stuff I'm supposed to tell you to do. And with that said, you guys, I will see you in the next episode. Bye, y'all.
Thank you.